Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
And good evening. I'm Michael Hartzman. Today is Tuesday, February 22nd, 2022. And as always, I'm on with my partner, Dominick Tavella. How are you, Dominick?
Good evening, Mike. Doing well. How about yourself?
I'm all right. Today is literally Tuesday, I've been told, TWO. It's 2/22/2022. So that's probably not going to happen again in our lifetime. So happy Tuesday.
Yeah, I guess you could say that, Mike. We came out of a nice holiday weekend and an opportunity for all of us to relax and catch our breath a little bit. And the headlines caught us square on. Not that we didn't know it was coming, but it certainly disappointed the markets. And happy Tuesday, right, Mike?
Exactly. Look, the market, this headline, I think, was written 2 or 3 weeks ago. I mean, this was inevitable that Putin was going to do something. He just was not going to back down. Neither one of us are geopolitical scientists nor experts, but in this area. But, the expectation was that Putin would do something, hopefully stop here. And if he does, then I think the market and the economy and the world will breathe a sigh of relief. If he keeps marching into Ukraine, Dominick, I think the market and the world economies will act negatively because of the ripple effects that will have on just the world.
Yeah, I mean, it's been a lot of noise, right? We talked prior to tonight that, more likely than not, Putin wouldn't do anything until the Olympics were over and done with. And
which is what he did.
Which is almost exactly to the minute. So I want to go, it wasn't an incredible surprise, but you still, when people don't act in a common sense, logical way, and in this case, you have to believe it's all about ego. It's disappointing, right? As I like to say, we certainly knew it was coming and we prepared, and I'm grateful that we did. But the ramifications to world economy could be significant, and that's why the market's reacting the way it is. It could be significant,
and a lot of it is dependent. A lot of the ripple effects start with energy, and the cost of energy and the production of energy, and how countries like Germany and other nations in Europe receive energy from Russia.
A significant amount of their
significant. Energy. I think they make 17% of all the natural gas in the world.
Yeah, some countries more than others. Germany is a significant client of Russian energy. So is Italy. But, having energy prices go dramatically higher would have not only impact, obviously, on the European economy, and potentially, throw them into a recession. Let's be honest, they're borderline not in a recession, obviously coming out of COVID. This could be significant to their economic growth. And then higher energy prices here, certainly a byproduct, but it would affect us as well. And we're already laboring under high energy prices, Mike, high gasoline prices and fueling and heating our homes. So, I'm not saying it would throw us into a recession, but it would have economic impact.
Well, definitely have economic impact. And then there's also those cross currents between the Ukraine situation with Russia and rising interest rates here, because some would argue that the higher gas prices already creates an artificial tax or an artificial expense where things cost more and maybe gives the Fed some cover not to have to raise interest rates. Nobody wants a war, right? But there's now this back and forth that if this slows down the economy, does that give the Fed some time to be less aggressive with what some Fed watchers believe. They now have to, be more aggressive in the pace of which they raise interest rates.
Yeah, it really puts, we're obviously dealing with an exceedingly high inflation number. This could make that number really dramatically worse. Obviously, energy, whether it's fueling your car, trucks on our highways, heating and manufacturing plants, we can go on and on, right? Energy is the lifeline to our economy. So much higher inflation prices, energy prices leads right into much higher inflation. And then what does the Fed do, right? Their mandate is to control inflation, and that means much higher interest rates. Listen, the combination of those two, much higher interest rates and much higher inflation, we literally could get into that stagflation that we witnessed in the 70s. So again, I don't want to paint this as doomsday. There are issues that can help resolve these problems over time, but the short run markets are behaving, I hate to say it, like they're supposed to, in a risk off mode, and people are selling stocks and putting the money on the sidelines. Fortuitously, we did a long time ago, but markets are behaving the way they normally do in these circumstances.
Yeah, I'm glad you said that, because we also have to remember, Dominic, we have seen this movie before. We saw skyrocketing interest rates, whether it was after a hurricane or some other event.
War. We've seen this before, right? When the Soviet Union went into Crimea, when we went into Iraq twice. We have historical basis to go, this is normally how the market behaves, and more important, how long it takes for the markets to recover. Ironically, it's an incredibly short period of time. And I think that's a point we might want to emphasize to our clients, Mike.
Well, that was the point I was going to make. Exactly.
So go for it. Go for it.
I know that we have definitely seen this movie before, and we're in a resilient economy. And even when consumers see excise taxes on delivery, or whether it's a food delivery or a furniture delivery, you'll see a company add 5 or 10%. At the end of the day, consumers are resilient. Consumers represent 70% of the overall economy, and we always seem to be able to work through these events because most people do realize it's temporary.
Yeah, an interesting stat I used earlier in the day, and I think it's worth repeating. Brian Moynihan from Bank of America just put out a statement. Their credit card and debit card receipts were 17% higher than a year ago. So even in this time where gas prices are higher, cost of goods are higher, going into a department store is higher or a restaurant is higher, consumers are still spending money. They are, maybe we've talked about the exhaustion of COVID and they're just getting out. Clearly, bank accounts are relatively healthy. Consumers are still willing to spend, but where's that breaking point where they go, enough is enough? We haven't gotten there yet. Hopefully we don't, but we do got to pay attention to that.
I was out of town this weekend down south, and every restaurant we tried to get into was packed. So people are still out and about, and that is a good segue for our guest this evening, who's Bill McManus, who's managing director at Applied Insights team at Hartford. They're affiliated with MIT. We've had Bill on before. He has tremendous insights as it relates to retired people and future retired people, and how the world around them is changing through technology and social media. And although we've had Bill on a couple of times and heard him speak a couple of times, he always has a fresh approach and a timely approach. So I'm looking forward to his thoughts this evening, Dominic.
Yeah, I think most appropriate for not only the conversation we're having right now, but the volatility going on in the markets right now, and how do people deal with that and the stress of it, and how they view their retirement and their accounts during these very stressful periods, right? So his insights, I think, not only can help us, but maybe our clients that are listening to the program going, hey, wait, that's me. And maybe I need to kind of refocus about how I think about things.
Well, I will say this, and you and I talk about this all the time. I'll give our clients credit. I spoke to, 15 of them today. They're all patient. None of them are panicking. And they all feel like they've seen this movie before as well.
Hopefully it ends the way it's ended in the past, Mike. That would be nice. And obviously for us, a terrific opportunity to put some of our liquid assets to work. But we'll let Bill give us some insight and maybe some assistance in how we should be speaking to our clients and how clients should be thinking.
So on that note, we will be right back with Bill McManus from Hartford Funds.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominick Tavella and our special guest this evening, Bill McManus. Bill, great to see you again.
Great seeing you too. Thanks for having me back, gentlemen.
Welcome, Bill. Thanks for coming on board with us again.
Absolutely.
Your insight is always extremely helpful. And when we planned on having you on a month ago, obviously we had no idea what we would talk about specifically, but the timing is great because we are having volatility like we haven't seen since the pandemic, and our clients have been relatively calm, but I know you have some great insight as relates to investor behavior, especially through these volatile times when the market is mostly down every day.
Yeah, absolutely. As you know, we have a strategic partnership with the Massachusetts Institute of Technology and this program called the Age Lab. So, by virtue of the name, you could guess they're primarily studying, aging and changing demographics and the impacts of longevity. The lab is in the School of Engineering Systems, but that's only about a third of what they do. The remaining third it's kind of a mixed bag of researchers with different backgrounds. But a third is really every flavor of psychology that you could think of. So really tapping into, just behavior and decision making, certainly as we get into periods of volatility. And I know that that's what we can certainly discuss today. We've got some interesting ideas around that. I will, give a little bit of a caveat though, to go to the heart of what the lab does. No matter what's going on in the world, geopolitically, economically, socially, there's still big issues that we as individuals need to be thinking about and planning for as it comes to longevity and housing and transportation and all the things that we typically think about. So those don't go away, right? When we're in a period of volatility, and in some cases, maybe we want to pay more attention to those, but, we'll certainly address sort of more timely topics, but always having that in the background.
So what is your takeaway as relates to what we're seeing right now, two investors, ones who are especially retired, right? Is their instinct first to say, oh my God, I got to sell? Is it, what's their primary instinct in your opinion or MIT's opinion?
Sure. So there's really three. There's three instinctual reactions that we'll tend to have. And I'm glad to hear, and it doesn't surprise me that your clients are calm and understand, but instinct, we can't train that, right? We can't have that go away. We're going to have these feelings. So the first one is that we tend to invest our attention into the negative. We seek out information to affirm maybe a belief that we have. It's actually caused that there's not to get too wonky, but there's a system in our brain called the reticular activating system. And basically what it is, it's a filter. Our brains are amazing, right? We can observe countless bits of information, yet we can only process so much. So this will actually seek out, information that's top of mind, and it'll, filter away things that it doesn't. So, for instance, you may have had this experience before. You buy a new vehicle, right? Let's say you buy a new, we'll use the crazy example. You treat yourself, you buy a big yellow Hummer. Now there's not many big yellow Hummers out there, but once you buy that, all of a sudden, what do you see? Yellow Hummers on every highway that you're on, right? So that's how this system works. And the sort of challenging part about that is the media is acutely aware of that, right? So they will feed us the information that, we are sort of seeking out on that negative bias. I use the example of, because the media exaggerates just every once in a while. I don't know if you guys really? Noticed that. Yeah.
Just once in a while.
Just once in a while. Think about how they report on the market returns on a daily basis, right? It's never the market was up or down today. It's the market soared today or the market plunged today, right? I think about this. I live in downtown Austin. High rise is going up like crazy, obviously up in New York. Imagine getting into an elevator and not seeing up and down in a high rise, but seeing soar and plunge. You're taking the steps, right? You're not getting on that, right? And that happens to us. And that's why I say, the initial reaction that we have is not wrong. It's not bad. The key is to not let that initial reaction cause an action that's not going to be in our long-term best interest. So certainly something to be aware of. We'll tend to seek out that negative information.
But Bill, and look, I'm not trying to make light of it, right? But you do, and it happens to me all the time. I'm sure Michael will agree. The new client comes on board, like, well, every time I invest, the market goes down. So they're literally coming in with this preset notion that just the mere experience of putting money to work means that they're going to influence the entire market, the entire world economy is going to go down, right? I mean, it is a
I kind of joke around and tell some of my friends whenever I have a great stock idea that they should be on the other end of that. But so that's tied to another one of these instinctual behaviors, and that is loss aversion, risk aversion. There was actually a study done by and I'm sure you gentlemen are familiar, a psychologist, Nobel Prize winning economist, Daniel Kahneman, out of Princeton University. He wrote in this book, Thinking Fast and Slow, about this research project all about the pain of a loss. And what he found through his research, the pain of a loss, emotionally speaking, is 3 to 4 times greater than any gain that you would have. So for example, say you're leaving the store and you're getting into your car and you look down and there's a $20 bill. You pick up that 20, you put it in your pocket, you're happy, right? First of all, you look and make sure nobody's, chasing around the 20, but you put it in your pocket, you're happy. You get home, you unload the stuff from the store, you go to tell your family about the 20, you reach in your pocket, it's gone. You have no idea where it is, you lost it. The fact that you lost it will bother you 3 to 4 times more than the joy you had when you picked it up. But economically speaking, you're no better or worse off than you were when you left the store, but that will grate on you. So that's why when you look back at, sort of the history of the market, if you look, we have this chart at Hartford Funds going back to 1926. And you look at quarter by quarter by quarter returns, 76% of the time it's positive for an average return of like 10.3%, which, we would all be happy with that. Yet it's that small fraction, even though it's much, much less frequent, that we just tend to hang on to and we tend to stick with. And again, it's not our fault. It's this, the pain of a loss is real, and it, can, instruct how we think about things on a go forward basis. I think the real key there is perspective, and you were sort of alluding to it before, Dominic. There's been 34 times that the market sold off, over 20%, in the history of the market. We're 34 out of 34 in terms of coming back to those previous highs and going on to set new records. There's never been a period of time in the history of the market where after a sell-off, we haven't come back to those previous highs and gone on to set new ones.
It's just a matter of time, right? And being able to have the fortitude to hang in there and allow time to heal all wounds.
Absolutely, and it's not easy, right? And I don't want the audience to misunderstand. I'm not, painting the world with rose-colored goggles, but just looking at the facts as we've seen them happen before. So it's really the time and the patience, understanding that we will have these emotions that swirl, which is fine, but not letting them again cause an action that could take us off of the plan that we have put in place.
So Bill, you just solved a mystery for me from over the weekend. I went golfing on a golf course, which was beautiful, but it had alligators literally on every water hole. And the starter literally spent 5 minutes explaining to my group how we should not get within 60 feet of these alligators. Right. And I'm thinking, why isn't that not obvious? Right. I don't want to be within anywhere near these alligators, but clearly what you're telling me is that if a golfer, the idea of losing a golf ball is more important to him than getting his leg chopped off by an alligator.
No, Mike, I have to interrupt you. It's not the golf ball, it's the extra stroke on the scorecard.
That's a loss too.
They will do anything not to have that extra stroke on the scorecard. So sorry, Mike.
That is painful. That certainly is.
But it's a valid point, and it's a good analogy that the possibility of that loss will linger, right? Because today, when I did a couple of reviews for clients, I went back to their history over the year, and on many clients, it said, yes, you've lost money, but you're the same place you were in November. November of
Mhm.
2021, 4 months ago. But still, how are we going to make this back? Right. So they know intellectually they have to be patient, but that pain of even going back to where they were 4 months ago, they have to rationalize that.
Yeah, absolutely. And it's a real feeling. And we don't remember those good times, right, as much, and how we got there. And same thing, like kind of going back to my attention to the negative, we actually have another there was a graph we put together, and it was spikes, because you can do Google Trends, like you can see what people are looking at when. And if you go Google Trends CNBC, what you'll find is the highest spikes of searches and the highest frequency of searches for CNBC coincide perfectly with the biggest downturns in the market, which that's interesting. But what's more interesting, you can see when the market's just going up and up and there's not a lot of disruption and things are sort of fine, people are tuned out, right? We're not paying attention to CNBC or Fox, Business or Bloomberg or whatever it may be. We're dealing with other things that are important in our lives. So it all really sort of coincides into this, again, instinctual behaviors that we have, or reactions that we have, I think is the more appropriate way to think about it.
But Bill, isn't that really part of where media and social media is today? I mean, I made a joke early with Mike, that because I don't want to age me and Mike, but we've both been in the industry for over 30 years. And literally the client would get a statement once a year showing their investment portfolio. And today everything is instant, right?
Mhm.
And one cable channel is fighting another cable channel to sensationalize the event. I mean, certainly this weekend, you couldn't turn anything on without hearing Putin and most people couldn't find Ukraine on a map. Yet it's the headline, right? Isn't all this noise just making a bad situation even worse?
Oh, I mean, absolutely, Dominic. And yes, how we, look at our accounts and things like that, but just how we consume information. You don't have to rewind the clock that far back. I mean, you go back, let's just say 20 years, and our main sources of information was, a nightly newscast from probably one of three broadcasts, a newspaper in the morning, maybe a magazine and a periodical here and there. But geez, you fast forward today and it's in those mediums, but it's also right on the computers, the tablets, the phones, on your watch, right, giving you these pings and things. It's ubiquitous. It's really hard to sort of step away from it and escape it. So I think that's why perspective is so positive, and positivity is so positive. That's what I'm always trying to preach, because one of the other instinctual behaviors that we have, if something's ambiguous, we'll tend to have a negative connotation to it, right? If I don't understand it, it must be bad. So to your point, finding Ukraine on a map, hearing things, what were those towns? Donetsk and Lukashenko and Nord Stream 2 and false flags, right? We hear these things, and I'm an avid traveler and I've never heard of any of those places or these things, and we automatically think it's bad. The way I look at that is there's always a reason, there's always something, right? There's always a reason not to be optimistic, a reason not to invest. We just live in a complicated, complex world, right? There's always issues and challenges. So I like to flip that perspective. There's always reasons to, I think. We just look at advancements in technology and the efficiency it creates. I mean, we're doing this on our Zoom call. I mean, this just didn't exist, a few years ago. There's always things going on. AI, 3D printing, all of these things that are going on out there that are only just going to improve our lives, right, as society, which ultimately will improve the economy as well. So I know sometimes it's tough, but I think pointing to the positive and thinking about the positive can really be prescriptive, when we're in times of volatility, for sure.
So Bill, we only have about a minute or two before the break. So I guess what I'd like to do is kind of set up what I'd like to talk on the next segment, and what you just said is really important. Technology has improved people's lives, but a lot of our older clients live off the grid, right? They're not a part of printing out boarding passes on their phone or getting coupons for the store on the phone. And, we could go on and on and on. So I know MIT and you guys have done a lot of work in helping people adapt and getting used to technology and how it could be their friend. And I think, I also like to talk about the effects of COVID in the last 2 years on some of our older clients, especially, and where you guys land on that.
Absolutely. As you know, we've got our one of our projects, 5 Ways Technology Will Change How You Age. So certainly looking forward to talking about that. And then what we're going to find is COVID has really been an accelerator of a lot of trends. So we'll certainly discuss that after the break, because we definitely have some insight into that.
Well, great. I know Dominic has a lot to ask you as well. So this first segment went super fast, and we will be right back right after this break.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner Dominick Tavella, and our guest this evening, Bill McManus from Hartford. Bill, let's talk about the pandemic for 2 minutes. Dom and I, always say that we didn't anticipate managing money through a pandemic. It clearly wasn't on our bingo card, and I don't think it was on anyone's bingo card. And it's been tragic on so many levels. But now we're at the point where, just people who survived it, who have gotten through it, especially retired people who had so many plans, are just angry now that 2 years or whatever plans they've had are just gone. And obviously they can't get those 2 years back. So have you guys done any research on that? And you have any advice for our clients on how to approach that?
Yeah, well, I mean, I'll certainly echo your sentiment. I mean, we certainly didn't expect or understand the full weight of a pandemic, and I'd say I know myself certainly didn't expect it to last as long as it did. That we'd still be discussing it and having it just alter maybe in a lot of cases, not necessarily our everyday lives now, but certainly our psyche and how we think about things, and certainly speaking to the time lost is a challenge. I will say, some silver linings, which, I tend to be to the positive side, especially speaking about technology like we had before.
Mm-hmm.
And I'll preface this by, I will never say technology is an apt replacement for kind of how we typically are used to living our everyday lives, specifically when it comes to social connectivity. But it's proven to be a pretty good supplement. And I think in a lot of cases, it forced our hand, obviously, in a lot of negative ways, but I think in a lot of positive as well, being able to, embrace some of the technologies that, had existed and we were using, but maybe just kind of dipping our toe in the water. I mentioned before, sort of when we're talking about Zoom and we're talking about a little bit of a different fashion, but, speaking to what I was mentioning before about some of the big things that happen, yes, we think, okay, this is great. Now we're using FaceTime because we can't, go to dinner with each other, especially in the beginning of the pandemic. But, just looking at demographics, let's think about our family as a pretty big source of our social connectivity and friends as well. The baby boomer generation has fewer children by 2 than the generation before, the World War II generation. And children are much more likely to be geographically dispersed. So, a situation where, maybe somebody had that weekly phone call and, look forward to the annual visit or the, twice a year visit with the grandkids, now all of a sudden has tools and technology where they can have breakfast with them every Saturday morning and watch them play and see the smiles and hear them laugh. And now that's not going to go away. People are not going to stop using that because, we're at the tail end of the pandemic. It'll just supplement, those other interactions. So I think that there have been some positives, but certainly some challenges and, maybe some opportunities to sort of recreate that bucket list, or like I like to call it the life list, might just sort of put an accelerator on that and folks saying, okay, we're through this. I'm, going to get back to it in earnest.
Bill, we kind of touched on it earlier, and we went from, and at least in our world, using the word exhausted by everything around us, to Mike, I think, appropriately used the word anger. And we're seeing literally, protests in Europe. We all know what's going on up in Canada with the truck protests. We see what's going on at school boards and parents getting angry. Are you guys getting a sense of that this thing is really starting to boil up, maybe boil over? Are you guys seeing that in your study?
Yeah. So, and again, this is not my specific area of expertise,
right,
but adjacent to some of the work that we're doing, I think it certainly is illustrative that, we all have breaking points, right? And there's only, certain things that we will endure. And then, at some point, people are going to get back to living their lives, and people are going to, sort of push back. And again, we're not getting into, political type discussions, but I mean, I think it does sort of speak to, and I think it goes to sort of how we think about, investing in the market and financial planning, right? We're entrepreneurial and we want to, take advantage of opportunities, and we want to, participate in a lot of the exciting things that are going on out there. And when that's stifled, I think that that pushes, folks a little bit, and hopefully to a point where we can, push through and break through and get back to, the new normal, the next normal, however we want to describe it. Things will certainly never be exactly like they were before, but I think, we'll see some improvements certainly going forward.
And you do make a valid point that things like tools like FaceTime and Zoom have actually improved the lives of people who live alone or who might feel isolated. I remember in the beginning of the pandemic, I have a good friend who lives alone, and every Sunday he would call his friends. He would FaceTime them and his words were, "We just need to connect." So thank God, we had these tools at this time, right? Because if this was 15 to 20 years ago, I think the isolation would have been even much, much worse.
Yeah, I mean, absolutely. I mean, I think, we find a way, we always do, as humans, but you're exactly right. I mean, thank goodness we have these, and not only from a social connectivity standpoint, some of the big ticket items that the Age Lab talks about, the social connectivity is certainly one, but housing and access, right? How do we access what we want when we want? So, have a lot of situations kind of pre-COVID, if someone's isolated, maybe not, hopping on Amazon Prime or the grocery delivery services and the meal kits, they just didn't exist, or they did, but we really didn't see the impetus to participate. But now people have, and they've seen the benefit of it, and will continue, to use those types of things going forward, to I think help, as we're sort of navigating some of the complexities of longevity.
And, Bill, I think, and sometimes I know we manage assets, but sometimes I wonder if we're more psychologists than money managers and wealth planners. But for us, it's about bringing that client back to what's important to them, right? Reminding them that, hey, you wanted to take that trip, go ahead and do it. Don't worry about what's going on in the market today. Or, you wanted to go and buy the car, or you really, trying to bring them back to that thing that kind of brought them joy or will bring them some joy in life. Obviously being fiscally and financially responsible, but maybe kind of bringing them back to what's important in life, and all this other noise, maybe let's carve it out a little bit, not focus on it.
Yeah, I mean, I totally agree with that, and I also think, again, looking at silver linings as a positive person, that might be a good impact from what we've all experienced over the last couple of years, where we're going to be more willing to go out and do those things that we wanted to do, because we experienced a period where we weren't. Everyone I know did not like that. I think of my grandmother, who's the most social person I can imagine. I actually, she still has the white, she uses a lot of technology, but she still got the whiteboard, social, calendar on her fridge. And I'll tell you, it puts me to shame. I look at it and I go, man, I need to do some more stuff. I need to have some more fun, because she's out there living up. She had a really, she lives in southern New Jersey, where, it was, pretty strict. She had a really, really tough time, for that first, 6 months or longer. But I'll tell you, I can't even count the amount of vacations and cruises that she went on last year, because she just, said, as soon as I have the opportunity to do something, I'm doing it. So I think that could, what we experience could drive people, to really do these things that we want to do and experience it, and not necessarily be as concerned about the financial implications, obviously, because they work with you guys, so that's all taken care of. But I think that's a silver lining.
Bill, a couple of years ago we heard the expression that a 50 is a new 40, and I'm beginning to think now that 80 is a new 70 and 90 is a new 80, because I have, and Dom has, so many clients in their 90s, in their mid 90s. They're still active and vibrant. And I have clients 86, 87, 88, to your point, like your grandmother. They're still traveling. They're still living their lives. So I know part of the MIT's work was to be empathetic to the aging population. But I agree with you. The aging population seems to be able to run circles around people half their age.
Me for sure, Mike.
Yeah, me too. No, I totally agree. I mean, you can't, these are the positive things, but, if you're watching the news or reading, websites, you can't go a day without seeing a story of people, let's just call it knocking down some of the traditional age barriers, right? Somebody's running a half marathon or a 10K or doing something that, you wouldn't even think about, a couple generations ago, but, people are embracing life. And obviously we've come such a long way in, medical advances and just awareness of health and wellness, and people are just, so not only living longer, but they're living, differently. I saw a report recently. It was work done by folks working with the Age Lab, saying a typical 65-year-old needs to plan on 25 years of healthy aging, that not just aging, healthy aging without any substantial disability. So it really sort of changes the game in terms of that. And, the other thing that's kind of interesting, and we're seeing maybe not so much on the older end of folks who have been retired for a while, but one thing that we did see, and again, I kind of put this as a silver lining as well, people rethinking about the role of work in retirement. Because I'd say for some folks, and, there's anecdotal evidence and we've seen some research, a lot of folks, like once we were thrust into the pandemic, almost gave us a little snapshot of what retirement would be like if we weren't retired, if we were contemplating it. Because all of a sudden we are home all day and we're with, our significant other all day long. And yes, we're busy with work, but the camaraderie and some of the other social interactions, all those things kind of go away. And I know a lot of folks who said, I'm not sure if I actually do like being at home all day long, right? I want to, be out and doing things and interacting. So could potentially have people, rethinking, retirement, kind of on both ends of it because of what we went through.
I just want to touch on because I want to emphasize a point you made. A client comes to us today at 65 and like, well, I'm retired now, so I need to really be conservative with my portfolio. And it's a constant discussion for us going, hey, you're 65, you're not 95, and we can't have a portfolio for the next 3 minutes or even the next 3 years. We have to think about 25 and 35 years down the road, and that this money obviously needs to be here, but also needs to keep up with inflation, needs to grow, and obviously needs to meet your future expenses. So we can't get too conservative. We still need to leave an element of growth in that portfolio.
Well, absolutely, Dominic. And I'm pretty sure I shared with you guys before, and you're familiar with our 8,000 day framework, 8,000 days of retirement. So, 8,000 days, if you convert it to years, it's like a little shy of 22 years. So if you think about it, an average lifespan, you can segment it out. So just to kind of put things in perspective, from the time you were born to the time, let's say you graduated from college, that's about 8,000 days, right? 22 years, from that period to, as I like to say, your first midlife crisis, because we have multiple now that we're living longer. That's another 8,000 days. From then to traditional retirement, again, you see the pattern, 8,000 days. So for, all of us today thinking about that last phase or that fourth phase, it can be another 8,000 days or 10,000 or 12,000. So, it's a third of your adult life. That's a lot of time. So, not only as that pertains to how you invest and the approach that you take, but also what are you going to be doing, right? For as much time as when you were born to when you graduated from college, how are we filling that with, meaning and purpose and challenges and camaraderie? Again, all the social stuff ties into that. Actually, the Age Labs, it's being baked. So maybe next time we'll go into a little bit more, but they talk about the social portfolio and almost how you should build your friend group, like you build out your investment portfolio. You want different things to do different stuff at different times, depending on what's going on. So I think that's kind of an interesting way to look at that. So maybe for our next discussion, once that's a little bit more baked out.
And so we do look forward to that. And I know one of your other programs that you had, and we joked about it when we did the show last year, was who's going to change your light bulb. And this was important to Dominic. Who are you going to go have ice cream with? So these are still important subjects, right? I mean, who are you going to count on, and who are you going to go to when you need something mundane like that, so you don't get on a ladder yourself and break a hip.
Yeah, exactly. And that's, when we started our conversation, and I mentioned, if you have a let's just say a chat, if something that's, dealing with some complexity around longevity, a fall or something like that. It doesn't matter if Russia is invading Ukraine at that time, right? That's not important, right? What's important is, you and your family and the sphere that you have around you, and certainly, what that means for your plans going forward. So those are the kind of things, and those are the kind of things that we can control, right? Oftentimes the stuff that's out in the world, we've got no control over that, but, we can control certainly how we react to that, but certainly the things that are within our sphere.
And Bill, to emphasize again your point, whatever happens today or tomorrow, or even in the last 12 months, when we look at it over a 10 or 20 or 30-year time frame, in hindsight, we're going to go, was that really that important? That market volatility really changed my world, right? It's just keeping a focus on the long-term goals here, and you get the clients through the rough times.
Yeah, I mean, absolutely, especially, with longer time frames. And, certainly, you all have clients that, volatility can affect if there's income and sort of when we take things, but that's why we have you, right? To help navigate through that. But certainly when time is on your side, right? We can go back and list, I was thinking about, I just thought about again when you guys were talking about, we've seen this story before. Mark Twain famously said, history doesn't repeat itself, but it certainly does rhyme. Right. Mm-hmm. We see these things, they tend to come up, periodically. And again, it's the circumstances might be a little different, but it's really nothing new.
Well, Bill, we've never had a guest end the segment on a Mark Twain quote. So kudos to you. And unfortunately, we are out of time. So thank you very much.
Absolutely.
And please let us know when this next thing is up and running, because we would love to have you back and continue, I think, which is a very positive conversations for our clients to hear.
Yeah, absolutely. Would love to be back. It's always a pleasure speaking with you gentlemen. And yeah, anytime. Appreciate it.
Have a great day.
Stay positive and keep smiling, Bill. Thank you.
That's right. Good advice.
And we'll be right back. All right, I'm Michael Hartzman, back with Dominick Tavella. Dom, as I was listening to Bill, it reminded me of what we always try to say to clients, that all of this is important and none of it is important. Because when they think about the market and what they're worried about today, I always ask a client, do you remember what you were worried about 6 months ago or a year ago? And 9 out of 10 times, Dominick, we know we were worried about something, but we can't remember what it was, whether it's in the market or life in general.
Yeah, I think that's the point I was trying to make with Bill, is that, we think something's important today, and in some ways it feels catastrophic, right? It almost like losing that $20 bill that he was talking about. But in the big scheme of things, losing a $20 bill, you didn't have it in your life before, you don't have it after, and it doesn't really change anything. And looking at the noise every day, you and I have to look at the cable channels. You and I have to look at the CNBCs and the Bloombergs and the Fox Business every day and keep track of this. And obviously we're expected to make good, wise decisions, but the clients, sometimes they need to turn it off, right? And just go back to trying to enjoy life a little bit.
Yeah. There's an old saying in the news business, right? If it bleeds, it leads. So, if it's a lead story, it's going to be depressing. It's going to be stressful. And if you get bombarded with that information, literally, like Bill said, on your phone, on your watch, you got to be able to take a break from that. Yeah, I have to take a break from it. You have to take a break from it.
And Mike, again, we're saying this out loud for hopefully everybody else's benefit. But if you are being bombarded with that noise 24/7, right? How is it possible you're actually going to make a good decision, right? If you have this kind of negative cloud, bam, 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 and then you make a good educated decision, it's really tough. It's really tough.
A long time ago, I was an executive recruiter, and we used to have an expression that certain personality was paralysis by analysis. And if to your point, if you just always trying to figure out the right time to get in or the right time to get out, you would get stuck. And Dominick, if we paid attention to every news story, we would not invest a penny ever.
Look, it's easy to find the negative, and Bill mentioned to us how just psychologically we're built to find the negative, right? Because in the old days that meant you got eaten by a lion or something.
Or an alligator.
But I want to remind everybody, March of 2020, when we had that horrific correction in the market, right? Today, if you just close your eyes, you didn't even know what happened. Even today, even with the correction we're going through right now, but 35% of people over the age of 65 sold completely out of the market. And in hindsight, that was the exact bottom, because that noise was so overwhelming that it just scared them into making a decision that in hindsight, they have to regret.
And to your point, Dr. Jeremy Siegel's weekly commentary came out today, and we read it. I read it like we do every week, and he's known as a permabull, right? But he's negative right now, and he thought that the market could go down another 10%, another leg down, but he still feels for the year that the economy will get its footing. This war story will work its way through, and the economy still in all is on strong footing, and this too shall pass.
And Mike, I honestly don't want to come off like, oh, this is all wonderful. It's all great. Look, there's a reason why we're holding so much cash in our client portfolios. There's a reason why we were very proactive in playing defense, right? Because we knew we'd go through one of these bad cycles. And if we didn't go through the deep roller coaster ride, it makes clients' life a little easier. But the point is, even through one of these cycles, we can survive, we'll get through it, and we will have happier days. Maybe not tomorrow, maybe not next week, but maybe 3 or 6 or 12 months down the road, we'll have much happier days.
And, look, we do the show every week, and next week we'll be able to revisit what happened. And the truth is, if Putin does take 2 steps back and stops right here, I actually think the market could have a recovery, a pretty quick.
Yep. And in case he decides not to and continue with his forward movement, we're prepared. Right. We prepare for the worst, plan for the best, but we'll prepare just in case. So I think hopefully our clients can sleep well at night, but it'll be rougher, I think, the next couple of weeks.
I agree.
We'll get through it. We'll get through it.
On that note, my friend, we are also out of time and we got to go.
Well, you have a very good evening, Mike, and we'll pick it up next week.
Be safe, everybody. Have a great night.
You as well.